Hey, hello, everybody. Welcome back to Finance Friday on the ARC UK YouTube network. Hard Money Jim, speaking today, as usual for this time of year, from beautiful Jackson Hole, Wyoming. And fall, of course, is a beautiful time to be here. Just by way of introduction, here's a photo of the entrance to the town square, just a couple of blocks from where I'm speaking, where I'm sitting. And those are elk antlers that form the arch. They're collected from the woods and the prairies around here by the local Boy Scouts, and they fashion them into these unique arches. There are 4 of those arches, one on each corner of the town square, and another one that you'll find as you walk, that you have to walk through after you get off your plane at the Jackson Hole Airport. And so, as you can see, the fall colors are really fine this year. And I want to assure you that no live elk were actually harmed in making these arches. All right. Okay, so there's a lot going on in the financial world. And it's hard to decide what to talk about. But there was an interesting incident about a week ago that an event that seemingly just came and went. Some people didn't even notice it, but I think it's a real bellwether for other things to come. So I thought we would all benefit from talking about it. And as we'll see, this incident I'm going to talk about relates directly to my favorite economic subject, namely money creation and its consequences. The incident I'm speaking about was the near blow up of the UK financial system. Did any of you read about that? Maybe some did. It was like a flash crash that might have been a disaster if the Bank of England had not come riding into the rescue with their checkbook in hand. And the incident, I think, is a sign of the the financial times that we live in. And so we need to have a basic understanding of this incident, I think, if we hope to understand the consequences of money creation and how to prepare ourselves for these consequences. So what happened was only partially visible to a casual observer, but it was very clear to bond market observers. Here's a kind of a hard to see graph. I hope you can see it all right, of the daily price of the UK's 30-year gilt from September 9th to September 29th. Now, the gilt is the UK equivalent of the US Treasury bond. These are bonds issued by the Exchequer, the UK's treasurer. And you can see that the daily price, starting about, around the 15th or 16th, started declining from and going down daily and reaching a low down here around September 27th. Now, this is a precipitous price move in such a short time, which you would know if you look at the bond market regularly. But then right down here, the bottom fell out of the UK gilt market entirely. And right down here, it's not reflected in the price because there was no more trades. There were practically no buyers for the 30-year gilt, except at rates that were going to go as high as 7 to 8%. But before that happened, before that could happen, the Bank of England saw a disaster somewhere, and they stepped in and they offered to buy huge amounts of gilts. I think 60 billion was the number they gave, in order to support the price. And of course, doing that brought the price right back up to this level. Okay. Now understand, these same bonds, which are now, as we'll see, trading like in the 4% range, 4% yield range, were trading to yield like 1% a year ago and only 2% a couple of months ago. And just so, in case you're not familiar with how sensitive long-term bonds are to a change in the market rate of interest, here's a little chart to illustrate the relationship. Now, this assumes you have a 30-year bond with a 2% coupon, meaning you buy a 30-year bond for 100, say, and it pays 2% per year. And as long as the market rate of interest is still 2%, that bond will be worth, the market price of that bond will be worth 100. But now look what happens when the market rate goes to 3%. The market price of the bond goes down to 80. So what you bought for 100 is now worth only 80, 20% haircut. If the market rate goes to 4%, your bond price on the market goes down to 65, and so on, so on. So if the market rate went as high as 7%, which it threatened to do, the price of these bonds would have been cut by 2/3, or almost 2/3. Now, normally, even big moves in the market like this don't cause central banks to intervene, just because of price moves. They do intervene, though. The banks, big banks, central banks do intervene when big price moves are causing stress and potential failure in some large financial entity, like, say, a too big to fail hedge fund or a bank. So someone owned these bonds and was under stress due to a drop in the market price. Now, who was the failing entity? We didn't know right away back last week, but we know now, and I will get to that and let you know about that in a minute. But to give you the economic backdrop for this mini crisis, let's mention some of the interrelated background issues, including things like exchange rates for the Great Britain, the GBP, I'll call it, the Great Britain pound, the Bank of England's QE, quantitative easing policies, consumer price inflation, interest rates, government spending, and national debt, and so forth. So let's start with the pound, the UK pound, which has been very weak versus every other primary currency around the whole world. Here's the pound versus the US dollar, the exchange rate going back 50 years. And you can see that it is near an all-time low. The pound is the worst performing currency versus the dollar this year. Over the last year, the UK pound, along with the Japanese yen, are down over 20% versus the dollar, while other major currencies have declined in the range of 10% or 15%. So the pound is behaving kind of like, a third world currency, like maybe an Argentine peso or something. Now, the weakness of the pound is due to several related factors. So let's consider what some of the most important ones might be. The value of a currency is generally driven by the expectation of what you can buy with that currency in the country where it's legal tender. So the question we want to ask is, what are the prospects for future spending of UK pounds in the UK? So I'm talking about not what will, definitely happen in the future, because we never know, but I'm talking about what the market is signaling it thinks will happen to the pound, is happening to the pound. So the question we want to ask is, why might you want to accumulate the pound? Why might you want to own it? So first, the UK economy has been flat with low growth, high energy costs, and the possibility of energy shortages this winter. So do you want to live in the UK and earn pounds given these poor business prospects and the energy shortage and face a cold winter with no heat? At the margin, maybe not, unless you think the value of the pound is going to improve, but clearly the market doesn't think that. So the point is, a poor economy and poor economic prospects reduces the demand for a currency and the value of the currency. And I have to add, the recent pound weakness is at least partly responsible, due to these net zero carbon policies that have driven up energy costs to levels never previously imagined. And those of you who live in the UK are facing this winter, and you know about it. And this, of course, high energy costs adds to the poor outlook for economic growth, and it causes business failures and lack of investment. It eats up everybody's budget. And so poor economic prospects in general, which are signaled by a terrible physical shortage of energy due to government policies, that definitely reduces or limits the demand for Great Britain pounds and lowers the price. Okay, so here's the stock market in the UK for the last couple of years. So do you want to get some pounds in order to buy UK stocks? Probably not. That doesn't look very appealing, that performance. Stocks of, this is the FTSE 100, the Financial Times Stock Exchange 100. So clearly a poor stock market, poor investment prospects in the stock market reduces demand for the pound. And next, do you want to get some pounds so you can buy some UK bonds? Well, probably not. I mean, this is the record of the yield on the 30-year gilt. And due to QE, it's come down and down and down and down and down. And so you get down here to the pandemic area, and it's trading at like 0.5 to 1%. So are you going to buy that bond? You can't accumulate any savings with that at 1 or 0.5%. So clearly low interest rates reduces demand for the pound. And of course, this is the yield on this instrument has just started to come up since quantitative tightening started, and then this little leap here that went along with the crisis. And so, finally, do you want to just hold some pounds in a UK bank account that pays no interest? You can look at the consumer price inflation in the UK here at 10%. It's higher than in the UK, where CPI inflation is already 8+%. But your money's worth a lot less. It's worth less every day. So notice also that that if inflation, if the bond pays only 2 or 3 or 4%, and you're going to invest money in that and earn 2 or 3 or 4%, while the cost of living goes up at 10%, that's a very bad deal. So that combination reduces, demand, reduces your desire to own pounds. So just to, sort of sum up this little segment here, all those factors make it almost intuitive that the Great Britain pound kind of has to be weak, by which I mean not highly desired by most investors and savers. And this UK tabloid headline kind of sums it up, and it indicates that the general population in the UK is wise to this inflation and the lousy exchange rate. So working people are now as concerned about inflation and exchange rates as they are about football and other juicy kind of tabloid stories. So the pound seems to buy less every day. Everyone knows it. So who wants to hold it? And you cannot invest it profitably in bonds or stocks. Why would you want it at all? Unless you have to live in the UK and you have to, earn it and spend it in the UK. So the pound is unpopular, mostly due to these low interest rates and rising consumer prices. That's what most people call inflation. So the next question is, what caused those low interest rates and rising consumer prices? And my answer if you have been to any of my talks or read any of the essays I write, because high prices and low interest rates are, in my view, mostly about excess money production. This is a graph of broad money growth in the UK from 2010 to the present. During the last 2 years, UK money supply rose about 23%. That's not as bad as in the USA, where it was up almost 40%, but it's bad enough. Most of this money growth was due to quantitative easing by the Bank of England, some of which was used to fund government deficits, and some used to fund direct pandemic relief payments from the government to consumers and businesses. Excuse me. Some of it also came from bank lending in the form of forgivable loans guaranteed by the UK government. It's all very similar to what happened in the USA. And in both cases, I'm speaking of unproductive money creation, which is inflationary. So, rising consumer prices or not, Um, you know, as some claim, primarily because of shortages of goods. Some people claim that. They claim that rising consumer prices are caused by supply chain problems or pandemic lockdown problems. But here's a graph of real GDP in the UK, which measures the real consumption of goods and services, which is a proxy for spending on goods and services adjusted for consumer price increases. So it's a reflection of real stuff, not pricing. And although the growth here is not impressive, the data does show real growth. You see in the upper right here, on the far upper right, hope you can see it. You do have small but positive growth over the pre-pandemic level. So very simply, to state the obvious, if prices were higher because of fewer goods available for sale, you would have to see fewer goods consumed, fewer goods sold and consumed. So that is, you would have to see lower real GDP, but you see higher real GDP. So based on this data, you can't claim that higher consumer prices were due to shortages of goods. But higher consumer prices are consistent with higher demand caused by too much money creation. And where did the new money come from? The same place it came from in the USA, the banking system, where all money in the modern era is created. All right, let's look at now at UK government debt. This chart shows UK government debt as a percentage of GDP. And you can see now, since the great financial crisis back here in this era, UK debt has soared just like it has in many other countries. Debt to GDP went from 40% to over 100% of GDP. So there's a lot of additional debt issued. And about a third of this debt, this additional debt, since 2009 was purchased by the Bank of England, monetized under their QE program. And as we know, QE bond purchases increase bond prices. They drive down interest rates while simultaneously creating new bank deposits. As you know, the same thing happened in the USA. So the major reason there's too much money and abnormally low interest rates in the UK is the Bank of England caused it to happen with QE, which is pure inflation. By inflation, of course, now I mean not just price rises, but additional money supply with mostly unproductive uses. So let's pause here and summarize a minute. UK economic growth is crippled, is characterized by restrictive energy policies, wasteful investments in renewables. It's funded at least in part by QE. This was central planning that did not produce enough goods to meet the increased demand that was caused by excessive money production. So the UK's cost of living is soaring due to too much money chasing insufficient goods. Most of this excess money was first employed by purchasing government bonds, which drove down interest rates, making personal savings impossible. But the low interest rates kept the cost of funding the government abnormally low, encouraging them to increase their debt. The investment opportunities are poor for various reasons related to low interest rates and restrictive government policies, high energy costs, and so forth. Bonds are giving you no return. The equity market's lousy. And now consumer prices are running away. So the UK central bank, like the Fed, is tightening to fight inflation so that interest rates, especially short-term rates, are beginning to rise. Now, all that is the backdrop to this September 26th mini crisis. But now, before I reveal the financial institution that was at the center of the crisis that was about to fail, let's pause for a minute for a question or a comment. Daniel, do we have anything I can take a stab at? Yeah.
We have a couple of super chats. First one from Ayn Rand. Thank you so much. It's off topic, but do you have any recommendations for books and resources to understand my capital, investments, property, etc., and to deploy them to long-term goals?
Books now. So if you want to understand money creation, I have several publications I've recommended in the past. And one of them is the best one to start with would be the Bank of England's paper you can find online called Money Creation in the Modern Economy. If you want to start with investment books, it depends on where you are in your knowledge. But I would say if you've had a basic course in finance, a basic course in investments, you understand basic concepts like, say, present value and so forth, and you know what an interest rate is, and you know what a bond is, and you know what a stock is, I would recommend take an old book. Some of the classics are good. One Up on Wall Street is a good one. The Intelligent Investor by Ben Graham is a classic, and you can't go wrong. I would probably start with The Intelligent Investor, and if you get through that, you'll be well on your way to knowing what you don't know to proceed. Let's put it that way. Okay. Anything else?
We have another super chat from Dwayne. Thank you so much. And last super chat from Kathleen. She's asking, could UK growth be helped by domestic energy production?
That's the one. Yes, that is the one thing that and Liz, this is, I'm going to get into Liz Truss in a minute. That is the one important thing, policy change that the UK could do without doing anything else to vastly improve its economic growth. Open up energy production, open up energy supply, pump from the North Sea, open up fracking. It provides real wealth and real jobs and real opportunity and lowers the cost for everyone else. It's the most important thing they could do. All right. Yes. All right. So where were we here? Okay. That question got me all excited because that's exactly right. All right. So here, let's go back to this hard to read graph for a minute. How am I doing on time? Oh, I'm good. Let's go back to this kind of hard to read graph that covers these 20 famous trading days in September. Now, around this period, around the, like around the 19th, the price of the gilt began to fall hard, day by day. But this seemed to be in response to a new economic plan announced by the UK new Prime Minister, Liz Truss. Her economic plan consists of reopening fracking for oil and gas, excellent. Lower taxes, probably okay. And more borrowing, not excellent, in order to fund more stimulus spending, all of which is designed to kickstart business activity. The market apparently saw Truss's plan as inflationary and thought that the government would therefore need to increase borrowing, and that would contribute to higher interest rates. And that prospect put downward pressure on the bond market. Remember, when interest rates go up, bond prices go down. So interest rates were already rising due to the Bank of England's tightening policies. But then on September 26th or 7th, in sort of a final revolt against Truss's plan, almost all the buyers of the 30-year gilt disappeared. And Liz Truss's politics took the blame for it. Like the Financial Times and Bloomberg and all the stories I read said, "Oh, Liz Truss is a right-wing." They call her a right-wing. Some even call her, a fascist. But I counter that the bond market was already fragile, as we have just laid out and have just seen. And I think those criticisms are overblown at best. So this chart shows the evolution of interest rates in the days just before September 27th. And you can see that the yield on the 30-year gilts started spiking up and was headed, it doesn't show on here, but according to the two traders, it was headed to 7 to 8% by some accounts. And that's a big move from 1% just a year earlier. But by September 27th, the buyers for the gilt were like disappearing. And as yields are spiking up around 4 to 5%, kind of up in this area, that's when the BOE announced that there was big stress, a crisis of liquidity, which means a crisis of liquidity in the bond market means there's no buyers for bonds, and that bonds being offered at a price and not being bought at that price. And it means that the BOE was ready to buy a lot of gilts to support the market. Now, that kind of thing always means somebody in the system, some big player in the system is in trouble and is about to fail. Price moves alone don't, as I said, don't cause the central bank to intervene. But if some important financial player, like a giant hedge fund or a bank, looks like they're about to fail, the central bank will step in to avoid a sort of a systemic breakdown. In past crises, these failures have been entities like hedge funds, investment banks, and commercial banks. Okay, so there's something, somebody's rotten. Where's the crisis? Drum roll. It turns out something was rotten in the UK pension system, of all places. UK private pensions are a mainstay of UK retirement. Private companies fund these pensions out of their earnings. UK pension funds are big buyers of the 30-year gilt. And why do they buy it? Because they have to invest today for a very long-term payout. They need a lot of 30-year bonds because they have to guarantee payments over a long period of time. So UK pension funds are big buyers of gilts because they have to have long-dated bonds. But UK pension funds also have to meet actuarial rates of return. And typically a pension fund has to earn 7 or 8% annually over a long period of time to meet the payout schedule of its recipients. 30-year bonds in a portfolio with other investments are therefore needed to fund these long-term obligations safely. But the Bank of England had pushed rates down so low, it's impossible to earn that 7%. There's no longer a safe 7 or 8% return out there. Now, I wrote about this last year. It's just impossible to save for the future when central banks push rates so low, and this applies to pension plans as well as individuals. All right, next step is the pension funds, therefore, have to reach for yield. You cannot accrue 7% with a 1.5% bond and a stagnant stock market. So therefore, in the era of low interest rates, UK pension funds have started to juice their earnings, juice their rates of return. Now, how can they do that? They can do that by taking unprecedented risks. Of course, they do this, they're heavily regulated. They do this with the permission of the UK pension authorities, which makes it even worse. But anyway, for several years, UK pension managers have been using a yield-enhancing strategy called liability-driven investment, or LDI. And LDI is kind of complicated. There's nothing wrong with it in the right hands. It involves swaps of income streams between, owners of variable rate bonds and fixed rate bonds and so forth. And we don't want to get into the details. I don't. But I want to illustrate in pattern how using this kind of leverage gets you in trouble when you don't assess the risks properly. So look, don't be scared by this busy looking slide. Just stay with me and I'll go through it. So here are 3 scenarios going from left to right. On the left, first say you own 1,000 of long-term bonds, and they're earning interest at 2%. So your annual income is 2% of 1,000. And the market value of your bonds is 1,000, as long as interest rates stay at 2%. And your net worth is 1,000. All right. Now, but you need to juice your returns. So look at this middle box. Suppose you can borrow short-term money at 1%. Now, by short-term money, I mean money that has an interest rate that varies, and it might even vary month to month, depending on conditions in the bond market. But you are going to bet, you, the pension manager, are going to bet that it remains stable. So you borrow 4,000, whatever, gilts, dollars, whatever. You borrow 4,000 at 1%, and you buy bonds with it, long-term bonds with it. So now you own a total of 5,000 bonds. Your annual interest at 2% is 100. Your interest expense, which is 1% on 4,000, the 4,000 you borrowed, is 40. Your income is 60. And so now your net worth is 100. So you are now on your original, this is what was paid in, your net worth, you are now earning a 6% rate of return. Not 2%, 6%. Yay! This is how you plan to pay your pensioners. Now, the lender, likely it's a bank, is willing to lend you this money at 1% because your long-term bonds are good collateral against your risk of not paying the loan. If you don't pay your interest, or if the value of your bonds start to go down a lot, the lender can legally take your bonds as payment. All 5,000 of them is necessary. So understand, these bonds you bought are your collateral against the loan you took out. So now, what happens? Remember, we had the table before. What happens when short-term interest rates unexpectedly rise just to 3%? That's the box on the right. So your income is still 100. Your interest expense is 120. That's 4,000 times 3%. Now you're underwater losing income. Moreover, when short-term rates rise, if you remember our table, whoops, sorry about that. When short-term rates rise from 2 to 3%, market value of your bonds went down by 20%. So your debt is still 4,000. Your net worth is 0. You are wiped out. And so this is what you call a margin call. When you get to this point, the lender is going to take all your bonds. Actually, before you get to this point, the lender is going to take all your bonds or enough cash to post more collateral. So this is called a margin call. And margin calls are the death of many, many leveraged investors. And this in pattern is what happened on September 26 and 27. Short-term rates were up, long-term rates were rising. The value of the collateral, that's the market value of their long-dated gilts, was falling. And the pension funds were about to get their bonds taken away from them by these short-term lenders. That is why the Bank of England stepped up to prop up the price of the 30-year gilt. So it's just like having a variable rate mortgage on your house, which I think variable rate mortgages are normal in the UK. This seems great at first, because as long as short-term rates stay reasonably low, you can own a 300,000 pound house with only, say, 100,000 pounds of equity, and maybe you're paying a low variable interest rate on the remaining 200,000. Now that's called leverage. And suppose your income's just enough to buy all the things you need and to live and still pay 3% on your mortgage, you're good. But if your borrowing rate rises to 4%, your mortgage service costs are going to eat up your income. So maybe you can no longer afford to buy gas. And then at 5%, you can no longer afford groceries. So you would have to give back your collateral, the house, to the lender, which is your bank. This is the same thing as a margin call, and it's what happened to the UK pension funds that use this LDI strategy. Again, the LDI strategy itself is not a problematic. But I might add that I suspect many of these UK pension plans are run by people who don't really know what they're doing and who took on this leverage, never dreaming that bond prices and interest rates could move so far and so fast. Most of the managers around today have never seen inflation. They've never seen sovereign bond prices, bond yields, rise above 4 or 5%. And so you have to ask, is this a pension fund, which is supposed to be conservative and never lose money, or is it a pension fund that thinks it's a hedge fund and makes risky investments? This kind of leverage is at the root of nearly all financial blowups, and this one appears to be no exception. So the Bank of England had to declare an emergency and pledge to buy gilts in a massive way to save the pension system. It claimed it was not buying gilts due to monetary policy, but in response to an emergency. But I will point out that the emergency itself was caused by the very monetary policy that the BOE said it was not now conducting. That is the policy of QE, and that is inflation and artificially low interest rates. So before the crisis, the market for 30-year gilts was already pretty illiquid, meaning there were not too many buyers out there for the yields that were offered, which means that to get a trade done, the market price has to move a lot. So, with the Bank of England not buying during their tightening phase, there's just not very many buyers left. So it looks to me like the entire crisis was set up by the previous policies of the Bank of England. That seems very clear. So then the expectation of higher interest rates and more inflation caused by the new trust policies was kind of the straw that broke the camel's back and kicked the 30-year yield market, 30-year gilt market into a tailspin, into a panic. Bond prices went way down as the market rate headed for, up to 7%. And that, excuse me, that's when the BOE stepped in, pledging to buy billions in gilts. Now, what would have happened if the Bank of England had not propped up the price? Pension funds would have gotten a big, fat, deadly margin call. They would have taken big losses on money that was, set aside for retirees. The other side of the trade, the lender, wants the pension fund to pledge more cash or more gilts, but the pension fund has so leveraged, it has very little of either. Their bonds are either already tied up as collateral, and their meager cash is reserved for paying out current customers. So if the BOE had not stepped in, you'd have pension funds legally insolvent, unable to make contractual payments. That is unheard of because it's a pension fund. So, I'm going on about this because this was bad. Because if the pension funds fail, then here come the mobs with the pitchforks, and understandably. Pension failures on a mass scale, that's the kind of stuff political uprisings are made of. Unrest, loss of confidence, and a major financial crash as people just sell everything to get to the safety of cash. So the knock-on effects could have been serious, and the Bank of England knows it. And just think what this dilemma means for the UK government. There were no buyers of UK government debt at these very low rates, at still very low rates. And there were only buyers at much higher interest rates. Debt to GDP in the UK government's already over 100%. And the interest on sovereign debt takes up about 3% of GDP and something like 8% of collected tax revenues. If interest rates go too high over time, interest payments can easily eat up most of the tax revenue, leaving little or no revenue to pay for all kinds of government programs, including entitlements, defense, public works, and so forth. So who besides the Bank of England is going to buy government debt when the inflation rate is way above the interest rate? In this case, nobody. Who's going to fund the government? So the government's running out of ideas. And this is why governments are keen to decrease the CPI inflation rate. They've got to get interest rates down. So the Bank of England, instead of continue to fight inflation with tighter monetary policy, has had to kick the can down the road again by pledging more QE to hold up bond prices and keep interest rates down below where they want to go. They're hoping they can eventually resume their tight money policy to slow down inflation, but I suspect this is only what we saw here is only one of many similar financial stresses that we're going to see in the world financial system. Now, I would quickly add that the UK is not alone. The USA and many other EU, USA, not exempt from this problem because the USA is lucky; it gets to issue the world's reserve currency. So many institutions and other country governments have been willing to buy U.S. Treasury bonds at low rates. So the strong dollar and the fact that the dollar is the world reserve currency helps the USA and helps our Treasury bond market because these institutions and nations and so forth need to buy some kind of investment denominated in U.S. dollars, the world's foremost reserve currency. And the best way to do that is to buy treasuries. But this exorbitant privilege, as it has been called, of the USA is not unlimited. Sooner or later, unless the US government reins in its spending, we will run out of treasury buyers at low rates, just like the UK did. And when the interest rates go way up, interest costs are going to threaten to eat up our national budget. So the UK pension dust-up, I say, is a canary in the coal mine. I very much suspect we're headed for another, maybe more significant liquidity event, maybe a sovereign debt crisis somewhere or something that looks like it. But where the next crack appears is hard to predict. Now, this event in the UK reminds us of the consequences of excess money creation. The weak currency, the super low interest rates, the excess money production, the pension fund risk, the loss of confidence in the bond market, all of this was precipitated by the UK's unsound monetary policy. And we as citizens need to learn from it. Okay, so now before I close and get questions, I want to say a brief word about owning gold. This is not an investment recommendation, but let me move this out of the way so you can see. Excuse me. All right, so here's we live in inflationary times, obviously, and gold is supposed to be a hedge against inflation, but it's actually not performed that well recently in terms of its dollar price, gold priced in dollars. I know I own gold, but this is partly because of the extraordinary strength of the dollar and the weakness of other currencies. In terms of other currencies, gold has done its job fairly well. So here's a long-term chart of gold priced in dollars. Now let's just go out to the far right, and you can see that over roughly the last year or so, the price has gone from about just under $2,000 an ounce to in the low 1700s today. That's a decline of about 15%, even though CPI inflation has gotten much worse during this time. And you might expect, gold should have done better than that. But now I want to show you, but you have to remember the strength of the dollar. And now I want to show you price of gold in Great Britain pounds. First, it looks the same, but look carefully out here. In pounds, the price of gold is actually close to its all-time high. It's actually only about 6 or 7% off its all-time high. So in UK currency, gold has done its job reasonably well to to hold its value. And notice on both of these charts, previously the gold price peaked at the height of worldwide financial stress, which is around 2011, 2012. and that it was rising from the time of the great financial crisis up to the time of the subsequent great stress. Remember, this was when we had, these are the years when we had all the problems in the European currencies, the European countries and their ability to pay. So it peaked during time of great stress. And so I suspect, I don't know, but I suspect that, and also notice gold is subject to these big moves and then, long-term corrections, and then big moves and corrections and big moves and corrections. So I don't know, but I suspect that if we have another major financial accident in the future, that we have a good chance of seeing gold do its traditional job as a safe haven asset that maintains real liquid cash value. So, I mean, I do own gold, and I will continue to do so. Jim Grant of Grant's Interest Rate Observer has an interesting observation. He says, the price of gold is the reciprocal of the level of confidence in central banks. So as that confidence in central banks declines, and I think it will, I expect the gold price to rise. All right, so I just threw this in for your entertainment only. All right, Daniel, let us stop there if I can still talk.
We have a super chat from Jeff. Thank you so much. He sends 10 Canadian dollars and says thank you. And those are all.
Now that's a currency that's not doing that bad. So thanks, Jeff. We'll take it. Thank you, Jeff.
And that's all.
Okay, good. So, all right, that's pretty good. About 47, less than 50 minutes. I am not entirely sure about, I just wanted to point out, I got in case you want to look, in capitalismmagazine.com, I got Money Creation, Who Cares, Part 1 printed. It's based on a talk I gave on this forum, not maybe a month ago, but it's more concise and it's got a few little additions, so you might want to check it out. That you can also find that on my Substack website. But the thrust of that article is you can understand money creation, and the only barrier to understanding it is not, your intellectual ability, despite what John Maynard Keynes said, that only one person in a million can get it. The barrier is to understand that banks just do create money with, a pen, an ink pen, or a stroke of a keyboard. But what's surprising in that essay is it's not much different from how they created additional money on top of the gold supply for hundreds of years. And one of the reasons that the system works, it resembles on the surface the same system that we had under the gold standard that worked for so well. Anyway, you can check it out, and I hope it motivates you to realize that this is not rocket science. It really isn't. It's something you can understand if you just understand a few basics. Okay, I'll get off my soapbox, stop there. I'm not sure about next week. I'm going to be at a gold conference in New Orleans next week. I hope to do a live broadcast from there. I'm not sure I can pull that off because I don't know the facilities there yet, but I'm working on it. So that's it for today. Thank you, everyone, for tuning in and listening, and we will see you, if not next week, then the week after. Take care.